Very warm welcome to everyone. This SKAGEN Kon Tiki update. Just as a recap, for those who don't know us that well, SKAGEN Kon Tiki is a global emerging market fund. That means we invest broadly across the world, but with a real emphasis on the faster growing emerging markets. Approximately 60% of the portfolio is currently invested in Asia, with a further 16% in Latin and South America, approximately 10% in Africa, and the remainder is invested in companies whose operations are predominantly in other emerging markets, but where the listing is in developed exchanges. In terms of the team, there's myself as the lead portfolio manager. In addition, there's Katrine Geter, who has long experience from the fund, having joined SKAGEN in 2009. And over the summer, we're very pleased to welcome Espen Klette, who's been an analyst with the firm and the fund since early 2019 as a portfolio manager over the summer. So that complements the already two people managing the fund, and very happy to welcome Espen into his new role. The fund is a value-based, actively managed fund with a relatively unconstrained mandate. So in terms of the key characteristics of the fund, they remain the way they have been for some time. Active share close to 90%. We only invest in companies where we have a bottom-up reason why they should be in the portfolio, and that we believe can deliver risk-adjusted returns. We don't look at the benchmark as a way of finding new positions, but are happy to go outside of it. That means that the fund has a relatively large, smaller and mid-cap tilt within the fund, especially if you compare it to the index, with about 45% of the fund invested in so-called large, small and mid-cap companies, whereas the vast majority of the index is in larger and giant companies. In terms of the value-based investment philosophy, we are currently at a pretty extreme situation. You should expect us to trade at a discount to the market through the cycle, but at this particular point in time, the fund is trading on just 5 times current year earnings and a 30% discount to book value. So these are roughly half the multiples that you pay for the wider emerging markets, which again trade at a significant discount to more developed markets like the US. So that we believe sets the fund up with some very attractive characteristics, especially considering the inherent quality and diversification in the portfolio. So what I wanted to cover today is to give an update on performance. We last gave a webinar in the middle of June, and as always, a lot has happened since then. That will take us into the portfolio, where we give an update on positioning, new companies that have come in, before we finish off with the outlook section and where we go from here. So if we start with performance update, I think it's important to set the scene. Back in June, we highlighted that we were in a market backdrop with more challenges, namely higher inflation, which we believe would last for longer than the market was pricing at the time, and also that we'd seen a slowdown in growth expectations, which have continued since. So with that sort of more challenging macro backdrop in mind, it's no surprise that the fund has also suffered a drawdown this year. So on a net of fees basis for the A share class, the fund is down 18.7% in euros as at the end of October, which is broadly in line with the benchmark. As you can see, the longer term investment performance of the fund remains pretty strong. But obviously over the last 3 and 5 years in particular, there have been some challenges with respect to the value factor being out of favor, but we see clear signs that that has started to turn quite dramatically, and partly explains why the fund has started to perform better, and we've seen that continue into the month of November. So in terms of the market backdrop, as we laid out earlier in the year, This is not a market backdrop that favors financial instruments. It is one that favors real assets. And you see that in the US dollar-based returns year to date, with commodities and oil having delivered by far the best returns year to date, and long duration government bonds and emerging market equities in particular had suffered as at the end of October. That's also reflected in the way that our portfolio has behaved. So in terms of the top 5 contributors, they are largely made up of companies from the energy and the raw materials sectors, particularly with respect to industrial metals such as copper. You can see that the Chinese upstream E&P company CNOOC is our largest contributor year to date. And on the energy side is joined by Total, which was a company that we took into the portfolio this spring. Also had strong performance from Turquoise Hill Resources, which is a Mongolia-based copper project called Oyu Tolgoi, which is subject to a bid by its controlling shareholder Rio Tinto. So we have actually exited that position at a profit. In terms of other positive drivers, they're largely to do with strong underlying markets in Brazil and in India. So the cash and carry operator Asai has performed very well on the back of strong operating momentum and also a very value accretive store conversion program from stores it has acquired. Mahindra & Mahindra is an Indian tractor and auto manufacturer, which has not only done well in an Indian market, which has risen, but also has performed strongly, particularly on the back of excitement around its budding electric vehicle program. And that is also a company where we have exited as the shares hit our target price. In terms of the negative contributors, they're largely made up of our Russian holdings, which made up around 9% of the fund at the start of the year. So Sberbank, as well as the Russian grocers Magnit and X5 have been a drag on performance. And as we will go to show, both South Korea and China have been weak markets this year, which, given that we had large individual positions in companies such as LG Electronics and Ping An Insurance in China, has meant that they've had a negative absolute contribution to the portfolio. By country, I mentioned that Brazil and India have been strong markets for us so far this year. And we also see that the other end of the scale are the more cyclically exposed countries such as Germany, Sweden, and for us, South Korea, but also as the geopolitical tensions in the Taiwan Strait have escalated, we also saw during the month of October in particularly a pretty big drawdown in both Taiwan and China. I think what's noteworthy this year is that the emerging markets as a whole have significantly underperformed the broader all-country world index as at the end of October by a full 10 percentage points, which again shows the importance of China in the broad index level and why that has done particularly poorly. In terms of the portfolio, I mentioned that at the start of the year we had 9% exposure to Russia. In our last update, we showed how those holdings had been priced at zero in the fund because we were unable to trade them. Since then, we have actually seen a market opening up in our X5, the grocery retailer, which still has its depository receipts, which are registered in London. Now, they don't trade on the London Stock Exchange at the moment, but there have been a number of off-market transactions at pretty decent volumes taking place over the last month and a half. And as a result, our independent pricing team within the Storebrand Group have decided to price the X5 depository receipts in line with those transactions that are taking place. We have not repriced any of our other Russian holdings because trading is not taking place in those names in a venue that would be accessible to us. The other thing that we get a lot of question around is our exposure to China, which has been increasing over the last 2 years. And this is just to illustrate our value-based and contrarian thinking. The blue line here shows the MSCI China index, total return index relative to the emerging markets total return index. And as you can see, over the last 10 years in the red numbers, we had held a relatively significant underweight position in Chinese equities as they had become increasingly dear relative to the market. However, what we've seen over the last 2 years is there's been a significant reversal in fortunes, partly due to COVID lockdowns, but also because of the regulatory onslaught on the tech sector and growing concerns about the property sector. As prices have been coming down materially, we have been adding to Chinese exposure because, frankly speaking, the valuations on offer better reflect the risks associated with it, investing in China, and I will come back to why we think that is the case going forward as well. But within China, I think it's very important for us to stress that it's not a country allocation. We are investing bottom-up company by company, and as you can see on the right-hand side, despite a challenging market in China year to date, we've had some notable successes on a bottom-up basis. So actually, when you look at the performance year to date, on average, our Chinese holdings have done better than the overall portfolio, and they've done better than the EM index. Now, if you compare our Chinese holdings to the Chinese market, they have on average, so on a money-weighted basis, outperformed by more than 20 percentage points, and a number of them have positive absolute returns. So we do think that even in a challenging market, it is possible for an active manager to add value through stock picking, even in China. Okay, if we look at the portfolio, the way it is set up today, I think one of the things that I want to stress, other than just the valuation aspect of the portfolio and how it, what a discount it's trading on, etc. I also want to just highlight again that, we are well attuned to a number of the secular or mega trends, if you like, that are many of the reasons why people want exposure to emerging markets. We have a number of companies that are well positioned in terms of health and wellness, big consumer trends, be they daily necessities or upgrading lifestyle products, but also through our Korean and Taiwanese holdings, we have exposure to some of the really big technology leaders. And obviously, as prices have come down in the internet space in China, we have also added online shopping to our repertoire, as well as having maintained a pretty sizable exposure, both to cyclicals and commodities. And we've had a long-standing exposure to the energy transition, particularly in the upstream value chain from mine mouth to battery producer. So, even if you buy a value-based and highly discounted portfolio, you can still get very, very attractive secular growth stories within it, in our view. To go into the portfolio itself, here are the top 12 holdings as of the end of October, and we have a number of the companies we highlighted on the previous slide in our top 12. You see Samsung Electronics has been a long-term holding of the fund. We have recently been adding to that position on weakness. You can also see that we have a significant exposure to well-run and shareholder-friendly energy companies such as Shell, Total, and CNOOC. And we have also added names over the last couple of years in terms of Hon Hai and Ivanhoe Mines, which have added another dimension to the portfolio. But if you look at the core characteristics of the portfolio, it's trading on 5 times this year's earnings. That's based on our independent bottom-up analysis of each security, and there's 30% discount to stated book values. Now, if I can draw your attention to the return on equity of the portfolio, because we've been adding to the quality of the portfolio over the last couple of years, we now have the same trailing 12-month ROE in the portfolio, so around 13%, as the broader benchmark, despite trading at half the valuation. So that's one of the many reasons why we are comfortable in highlighting that the upside in the portfolio at around 75 to 80% at the end of October is well grounded in fundamentals and does not require the portfolio to re-rate beyond a market multiple, as you can see on the bottom line. In terms of what's been going on in the portfolio, a number of these companies were highlighted at the last update, where we added the Chilean holding company Kinenco, as well as the Korean cosmetics producer Cosmax. You see that we have 4 energy companies, 2 traditional in terms of Total and Shell, and 2 companies in Brazil exposed to renewable energy through sugar and ethanol production. And we also have the diversified mining company Sibanye-Stillwater out of South Africa that we added during the course of the year. And lastly, we have also added the regional bank TGB in Korea, which is a very interesting opportunity with rising shareholder returns, and the stock is trading on around about 3 times earnings and 0.2 times price to book, with a 9% plus return on equity. In terms of exits in the portfolio, I mentioned Turquoise Hill and Mahindra as they reached our target prices or are subject to takeover. But it's also worth highlighting that we exited 4 Chinese companies during the course of the year: Holosys, Tencent, China Shineway, and Sinotrans. So it's not been a one-way street in terms of our Chinese exposure. We have been adding where we have new conviction, and we have been trimming where either the fundamentals have deteriorated relative to the pricing, or where we think that there are other more risk assessments that we want to make, be it in terms of governance or shareholder returns, which has meant that we have exited a number of Chinese companies during the course of the year. That leaves the portfolio quite balanced, both on a sector and a geography basis. In terms of our larger overweights, or where we have significant differentiated view, it remains within the material space and also in the energy segment, where we have 18 and 20% of the portfolio respectively. We also have a solid exposure to the consumer, both consumer staples but also consumer discretionary, as some of those prices have come down quite significantly during the course of the year. By country, I mentioned that Asia is our principal weight at the moment. That's driven by a roughly 25% each weighting in China and South Korea, where we do find a number of high quality companies trading at significant discounts relative to their global peers. And increasingly, we have seen that our weight in Brazil has gone up, partly because we've been buying more companies from there, but also because the performance has been strong, which means that the weighting has naturally gone up. For those who look at our developed markets exposure, that is predominantly our energy and our basic materials exposure. So this is where we can get upstream activities in emerging markets, or where the value creation takes place, but where the place of listing may be in countries such as the Netherlands, France, or Canada. I think one lens that we like to highlight that one should look at the portfolio through, other than just country and sector, is around our sort of our macro clock. On the x-axis, we have rising inflation, and on the y-axis, we have rising economic growth. What we've done is map the sectors, how they've done relatively historically versus the emerging markets index, and map them onto the economic environment where they do the best. So if you are worried about a stagflationary environment, then energy has historically within emerging markets, along with some financials, been significant outperformers. If on the other hand, you are in the Goldilocks scenario, where higher economic growth and inflation comes down rapidly, then clearly that's an environment that will favor more consumer discretionary and technology type companies. And really the point behind this chart is just to show that the portfolio is balanced across different macro scenarios. We are not macro investors. We like to find solid company-specific bottom-up stories and make sure that the portfolio construction can weather different outcomes in terms of the macro, because that's how we believe we build true diversification other than just through countries or sectors. Okay, in terms of the outlook, I think diversification is important at the moment. Clearly, year to date has had its challenges. Four that I would highlight from our perspective that I think will be important going forward as well. One is the failure of the traditional 60-40 portfolio to offer downside protection, as the correlation between equities and fixed income instruments have gone up, reflecting that starting valuations were high for both. We see that in that long yields have gone up in the US by 2.5 percentage points year to date. Unless inflation comes down going forward, we think that there could be more to go there. And obviously, part of the inflationary pressures that have been there is because the price of energy is higher by some way than it was just 12 months ago. And from a geopolitical perspective, obviously, what is going on in China, particularly around the recently concluded Party Congress, has meant that investors are placing a higher risk premium on geopolitical issues, especially relative to the Taiwan Strait. And I think it's worth also, we've talked previously about when investors are aware of a risk and they put it on paper, or they put their thoughts on paper, they are also able to price it. So it's interesting to see that the latest Bank of America Merrill Lynch fund manager survey does show that both inflation and geopolitical issues are front in mind of most global investors. And therefore, I think we are in a position where we can start putting a price on that and position accordingly. We still think that the risk reward of owning inflation protective assets is pretty good. Maybe it's not as good as it was 2 years ago before it started outperforming significantly. And in a similar vein, we do think that heightened geopolitical risk perception has led to lower prices, which may become more interesting to us. And one way to show that is that if you look at the market implied equity risk premium, here we've used China as an example. Now, the market implied equity risk premium is simply the estimated earnings yield on the index and subtracting the 10-year government bond yield. So this is basically the additional return one should expect from owning equities above the risk-free rate of the country. And as you can see, over the last 2 years, unsurprisingly, given the performance of China, that risk premium has increased significantly. And actually, at the end of October, it hit previous historical highs, which has been around 9%. Outside of the global financial crisis. So we are at historically very elevated risk premiums for Chinese equities. Now, if we then here in the green line overlay, well, what is the 12-month return historically when you have been at those kind of levels? So here we've just lagged the returns by 12 months. And as you can see, again, the drawdown that we've had over the last 2 years in Chinese equities, so the green line bottoming is very, very significant in a historical context. And if previous episodes of elevated risk premiums are any guide to what might come next, then the chances of a positive return looking forward look more attractive than for some time. Here I'm just showing the same analysis in a slightly different way, just showing it as a scatter graph. And again, I've put the line here with the current equity risk premium on the x-axis of just over 8% for China. As you can see, your historical hit rate over the last 15 years at that kind of level has been pretty good for positive absolute returns going forward. And we're already seeing some of that playing out. We are only 3 weeks after the conclusion of the Communist Party Congress on the 24th of October. And since then, we've already seen a narrowing of the risk premium after the capitulation on that day. And actually, we've seen a pretty significant rebound in Chinese risk assets since then. Now, part of that is driven by what seems to be a softening on the internal front in terms of COVID regulations, but also in terms of geopolitical risk assessment. If China does sort of engage with the Western world in a slightly more open way going forward, then I think that people may look at this event as pretty cathartic. Now, we are not for following other investors for the sake of it, but we do note that obviously one of the most famous and successful contrarian value investors of all time, who popularized the phrase "to be greedy when others are fearful," has placed a relatively big bet on the Taiwanese semiconductor company TSMC. Perhaps he is also looking at the risk reward in terms of being able to pick up attractively positioned companies at a time of non-company specific stress points. Now, we obviously have not had a shareholding in TSMC, but we are just noting that other investors have also been drawn to this situation. And what is the situation? It is still that emerging markets trade at a discount. That may be for historical reasons to do with a long drawn out period of underperformance versus particularly the US market, but it's also to do with perceived higher geopolitical risk. And what we see here on the left-hand side, that on both on price to book and a price to earnings basis, emerging markets trade at a historically high discount versus developed markets. And on the right-hand side, you can see that, despite us having been in a increasingly inflationary environment over the last 2 years, despite traditional value sectors such as financial, such as energy, such as basic materials, even though they have outperformed over the last 2 years, their discount, both on a price to earnings and a price to book basis, remain close to all-time historical highs at 50 to 60% discount versus growth companies. So we think that creates a pretty compelling backdrop for the kind of active value-based portfolio management that we practice in SKAGEN Kon Tiki. And I think just to reiterate again, the fund is a highly actively managed global emerging markets fund. We have a long-term and often contrarian investment bias, but we have a very, very clear focus on where we believe that there are sustainable long-term returns of value-creating companies that, for whatever reason, on a temporary basis, are priced well below their intrinsic value. Now, the portfolio is concentrated. We have only just over 40 companies in the portfolio, but we have spread those companies across a wide range of geographies and sectors. And most importantly, we have diversified the portfolio across macro scenarios, which we believe adds a good layer of diversification. And of course, every time an asset class underperforms by a significant margin, there is the opportunity to see an improved risk reward. Low prices to us is always preferable to high prices for expected returns going forward. And we think that given where risk premiums are currently in emerging markets, partly driven by China, but also more broadly, does mean that it's a very attractive hunting ground now for active investors such as ourselves. So I think with that, thank you very much for your attention, and I hand the word back to Ole Christian. Thank you very much.
Thank you, Fredrik. We have received a question for you, and it's about China, obviously, because that's a very important question these days. Now, what is your personal takeaway from the meeting between Biden and the Chinese leader the other day?
I think the honest answer, it's probably a little bit too early to say. I think the most important thing for me is that there is a willingness by China to engage outside of its own borders again. I think that's indicative of a less restrictive take on COVID. And number two, I think the lessons from what happened in Russia or in Ukraine by Russia in the last 12 months shows that the world is interconnected, and any kind of ramifications from a flare-up between the US and China would be many, many times worse than when it's only including Russia. So I hope and I believe that there is a broader understanding of the importance that the de facto two global superpowers do need to find a way to coexist. A compromise leaves no one happy, and maybe that's what we should hope for.